Hi, this is an example of why levels are so important even if they fail to hold. This is the E-mini S&P 500 and we can see here that on a daily chart trade had been defined on both sides of this center point. There's a high here, an open near here, a low here, a low here, and we're going to be looking at the action on this particular day. This is the 16th of November 2011, and if we look on the right chart, which is 2,500 volume, we can see that the market gapped lower, and initially it was right on this band between 1238.50 and 1235.75. Now it did push ever so slightly through, got to 1235, but it quickly moved back up and pushed higher, moved out of the band. Now we all know gap closes are often pretty strong pulls on the market, so what happened next was not unsurprising, and you can see already on the daily chart that it did close the gap, and it in fact did get a little bit higher, and actually it touched the close of the prior day at 48, right on the money. Oh, okay, so if we just scroll forward for the day, what happens is we get above into the higher part of the prior day's range, and then we fail back at its close. The market starts coming down, and actually it accelerates nearing the end of the day towards that area again, 1238.50 to 1235.75, and basically you could see this if you were looking at the chart on a 1 minute, say, with volume, but you can see that there are lots and lots of candlesticks for the amount of time. Each one is 2,500 volume, so it comes back to the area, it tests into it. It doesn't exactly bounce off it, but that's fine, and it gets down, and it gets right down below the 35.75, just on the low that was previously set for the day to 1235, and breaks it by a tick. And then what does it do? 1, 2, 3, 4, 5, 6, and then it starts moving back up. So that's 15,000 contracts all done within the space of 3 ticks around the low. Looks like a 1 tick low failure, right? And this isn't surprising because other traders may decide to take profit at this point, so there's going to be opposition. Other traders might think it's going to turn from here, so it looks like it might go up, but what then happens? It doesn't get a hold of that at all. We just go down, 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 down. But a useful part is that we know that recently trading activity has been happening on both sides of this dividing line, and once it comes back, there's a test, and it fails clearly. It starts to come back below recent swings, and it's a good opportunity for new lows. Anyway, you can see that later on, if you were, say, swing trading, trading a little bit longer term with a longer perspective on this, you'd have seen a nice decline for that particular trade. But just because the level doesn't hold exactly doesn't mean to say that it's not useful. So that's an example in the S&P E-mini 500. I hope you liked it.